You woke up on December 27th and checked your portfolio. And if you owned silver, you witnessed what looked like absolute carnage. The price had been obliterated. We're talking about a metal that had been grinding higher for weeks, testing $35, showing strength, building momentum, and then suddenly, violently, it got taken out back and executed. This wasn't a normal correction. This wasn't profit-taking. This was a precision strike that happened when nobody was watching, when nobody could defend themselves, when the market was essentially a ghost town. And here's what makes this whole thing so fascinating and so infuriating at the same time. While paper silver got demolished down to levels that made absolutely no sense, physical silver in China was trading at a massive premium. I'm not talking about a couple percentage points here. I'm talking about a gap so wide you could drive a truck through it. While New York paper contracts showed $75, Shanghai buyers were paying $89 for the actual metal. Let that sink in for a moment. The same commodity, the same asset, two completely different prices, depending on whether you wanted the real thing or just a promise on paper. This event wasn't random. It wasn't organic market movement. It was surgical, calculated, and executed with the kind of precision that only comes when you know exactly what you're doing and exactly when to do it. And I'm going to walk you through exactly what happened, who did it, why they did it, and what it means for you right now. The timeline of this massacre tells you everything you need to know about the nature of this move. We're talking about December 26th, the day after Christmas, at 3:17 in the morning Eastern Time. Let me paint you a picture of what the financial world looks like at that exact moment. It's the heart of the ghost week, that dead zone between Christmas and New Year's, when trading volume evaporates. When most traders are still sleeping off their holiday meals, when institutional desks are running skeleton crews, when liquidity is at its absolute lowest point of the entire year. The London market hadn't opened yet. New York was dead asleep. Asian markets were running on minimal staff because of holiday scheduling. This is the kind of environment where a handful of contracts can move the market dramatically, because there's simply nobody there to absorb the selling pressure. And that's exactly when they struck. At 3:17 a.m., massive sell orders hit the COMEX futures market. We're talking about contracts representing millions of ounces of silver getting dumped into the market in a matter of minutes. The price didn't drift lower. It didn't gradually decline. It got smashed. From $34.80, it plunged to $27.30 in less than 2 hours. That's a 21% decline in a commodity that typically moves 1 or 2% in a normal trading day. You could practically hear the automated trading algorithms screaming as they processed this information. Stops losses got triggered in sequence, like dominoes falling. Margin calls went out to leveraged traders who couldn't respond because they were literally asleep or with their families. Positions got liquidated automatically by brokerage risk management systems that don't care about your vacation schedule. And here's the thing that makes this timing so suspicious. This wasn't the first time. This exact playbook has been run before during holiday periods, during Asian trading hours, during times when Western markets are offline and can't respond. It's a pattern that repeats with such regularity that calling it coincidence requires you to abandon all critical thinking. The volume during this dump was enormous relative to the available liquidity, but tiny compared to normal market conditions. Under regular circumstances, that amount of selling would have been absorbed without moving the market more than a few percentage points. But at 3 a.m., the day after Christmas, it was like dropping a grand piano in an empty room versus dropping it in a crowded stadium. The impact was maximized because the timing was chosen specifically to maximize it. Now, let's talk about the mechanism behind this move, because understanding how this works is crucial to understanding why it happened. Silver futures markets operate on margin, which means traders only need to put up a fraction of the total contract value to control a position. Let's say margin requirements are 15%. That means you can control $100,000 worth of silver with just $15,000. This leverage cuts both ways. When prices move in your favor, you make multiples of your initial investment. When prices move against you, you can lose everything and more. And here's where it gets really interesting. Brokerage firms and exchanges have automated risk management systems that monitor positions in real time. When the market moves against a leveraged position beyond certain thresholds, these systems automatically issue margin calls. If you can't post additional margin within a very short time window, your position gets liquidated automatically. You don't get a phone call asking if you'd like to add funds. You don't get a consultation. The system just closes your position to protect the brokerage from risk. Now imagine you're a large institution or a sophisticated trading operation, and you know that there are substantial long positions in silver futures. You know these positions are leveraged. You know that many of them have stop losses clustered around certain technical levels. And you know that it's 3 a.m. on the day after Christmas, when nobody can respond quickly. What happens when you dump enough contracts to push the price down through those stop loss levels? You create what traders call a doom loop or a liquidation cascade. The initial selling triggers stop losses, which creates more selling, which triggers margin calls, which creates forced liquidation selling, which triggers more stop losses, and so on. It feeds on itself. The algorithms don't care that it's a holiday. The risk management systems don't care that traders are sleeping. They just execute. And if you're the entity that initiated this cascade, you can buy back your short positions at much lower prices after the panic selling has run its course, pocketing the difference. This isn't speculation. This is exactly how these markets function mechanically. The gamma squeeze concept that retail traders learned about with meme stocks works in reverse too. When you have a concentrated positioning and you can trigger forced liquidations, you can move markets dramatically with relatively small initial capital. The leverage in the system amplifies everything. And in low liquidity environments like ghost week trading sessions, that amplification gets turned up to 11. But here's what most people missed while they were watching the COMEX price crater. Someone else was watching this happen and they had to respond. The intervention in this case came from an unlikely source, and most people still don't know it happened. While silver was getting demolished in the paper markets, the physical market was sending completely different signals. Shanghai Gold Exchange, which is where real physical silver changes hands in the world's largest metals-consuming nation, showed prices that were wildly divergent from New York. At the exact same time that COMEX futures were showing $27, Shanghai prices were at $32. That's an 18% premium for physical metal. Let me explain why this matters so much. Under normal circumstances, arbitrage should close these gaps almost immediately. If silver is cheaper in New York than Shanghai, traders should buy in New York, ship to Shanghai, and sell it for a profit. This arbitrage activity should equalize prices across markets within reasonable bounds, accounting for shipping costs and time. The fact that this premium not only existed but persisted and grew tells you that something was broken in the normal market function. Physical metal wasn't available at those paper prices. The discount to New York was theoretical. It existed on computer screens, but not in the real world where actual silver bars change hands. Meanwhile, data from the COMEX vaults showed something remarkable. On December 27th, the day after the massacre, registered silver inventories dropped by 3.7 million ounces. Registered inventory is silver that's available for delivery against futures contracts. That's silver leaving the vault, getting claimed by entities that want the physical metal, not the paper contract. In a single day, more metal left COMEX vaults than in any day in the previous 6 months. Someone was standing for delivery demanding real silver at these artificially suppressed prices. And here's the intervention that really mattered. The Federal Reserve's currency swap lines with foreign central banks showed a spike in activity during the last week of December. These swap lines are tools the Fed uses to provide dollar liquidity to foreign institutions when dollar funding markets seize up. Why would these be activated during a silver price crash? Because when physical metal starts trading at massive premiums to paper prices, and when vault inventories start draining rapidly, it creates stress in the dollar funding markets that underpin these commodity trades. The system had to provide liquidity to prevent a broader disruption. This wasn't announced in a press release. This wasn't on the front page of the Wall Street Journal. But the data is there in the Fed's weekly balance sheet releases if you know where to look. Now let's talk about what was really happening in the physical market while paper prices were in free fall, because this is where the story gets truly wild. The Shanghai premium I mentioned wasn't just some temporary anomaly. It reflected genuine physical demand at prices that made the paper market look absurd. Chinese buyers weren't just paying $32 when COMEX showed $27. By December 28th, when COMEX had bounced back to $29, Shanghai physical was at $34.50. By December 30th, with COMEX at $31, Shanghai was at $37. The gap kept growing. These weren't speculative positions. These were industrial users, jewelry manufacturers, and strategic buyers acquiring physical metal for actual use. They needed the silver. They couldn't wait for convergence. They paid what they had to pay. And here's what really drives this point home. Indian import data for December, which gets reported with a 2-week lag, showed silver imports of 894 tons for the month. That's up 43% from November, and the highest monthly import figure in 18 months. India is the world's second largest consumer of physical silver after China. When both of the world's largest consuming nations are buying aggressively at prices well above the paper market, quote, you have to ask yourself which price is real. The answer becomes obvious when you look at what wasn't moving. Silver ETFs, which hold physical metal backing their shares, saw minimal outflows during the crash. The largest silver ETF, SLV, had exactly 0 change in ounces held on December 26th and 27th. If the price crash reflected genuine fundamental bearishness or real selling pressure from physical holders, you'd expect to see redemptions from ETFs. You'd expect to see metal coming back onto the market. Instead, metal was leaving the system. Vault inventories at major storage facilities in London showed net outflows of 2.3 million ounces during the last week of December. This is the opposite of what should happen during a price crash caused by oversupply or lack of demand. When prices fall due to real fundamental weakness, metal piles up in warehouses. Inventories build. Storage costs incentivize holders to sell. None of that happened here. Instead, sophisticated buyers recognized the paper price as divorced from physical reality, and they bought aggressively. They took delivery. They moved metal out of the Western banking system into their own possession. The arbitrage gap between paper and physical didn't close because there wasn't enough physical silver available at paper prices to make the arbitrage work. The paper price was a fiction that existed only for those willing to trade contracts with no intention of taking delivery. So if the real story was physical shortage and growing premiums, what was the mainstream financial media telling you? They had a narrative ready to go within hours of the crash, and it was completely wrong but perfectly crafted to shape perception. Bloomberg ran a headline that afternoon. Silver slumps as strong dollar and Fed hawkishness weigh on commodities. The Financial Times went with precious metals, retreat as traders reassess inflation outlook. CNBC's coverage focused on technical breakdown of support levels and suggested the crash validated bearish forecasts from major banks. Every single one of these narratives had the same subtext. This was normal market action driven by legitimate fundamental factors. But let's examine the evidence for these claims. The dollar index on December 26th was at 108.2. By December 30th, it was at 107.9. The dollar got weaker during this period, not stronger. So much for the strong dollar explanation. Federal Reserve communications during this period hadn't changed at all. The last FOMC meeting was December 18th, a full week before the silver crash. Nothing new had emerged in terms of Fed policy. The inflation outlook narrative was particularly absurd because inflation data wouldn't be released until mid-January. What exactly were traders reassessing based on? No new information had hit the market. Here's what actually shows up in the data. When you dig into flow analysis, retail trading platforms that report net positioning showed retail traders as net buyers during the crash. These are your individual investors, the people trading through Robinhood, Interactive Brokers, and other retail platforms. The positioning data is clear. Retail bought the dip. They saw $27 silver and they bought. Meanwhile, institutional flow data from prime broker reports showed large hedge selling in the futures market. Exactly the kind of selling pattern you'd see from a deliberate takedown operation. Short-term speculative accounts showed massive position increases on the short side right before the crash. This wasn't retail panic selling. This wasn't mom-and-pop investors dumping their silver. This was institutional operations running a coordinated assault on leveraged long positions during the most illiquid trading window of the year. The false narrative exists because acknowledging the truth would require admitting that markets can be manipulated, that they aren't always efficient, and that price discovery can be temporarily hijacked by entities with enough capital and knowledge of market structure. That's not a comfortable message for financial media outlets that depend on advertising revenue from the very institutions engaged in these activities. So instead, you get sanitized explanations about dollar strength and Fed policy, even when those explanations are contradicted by the actual data. It's a psychological operation designed to make you doubt what you saw with your own eyes. So what happens next? Where does silver go from here, and what should you be watching? The current market structure is absolutely loaded for a violent move higher, and I'm going to explain exactly why. First, understand that the leveraged short positions that were built during this takedown are still largely in place. Yes, some were covered after the initial plunge, but the net short position from commercial traders on the COMEX, which gets reported weekly by the CFTC, remains elevated. These are positions that will eventually need to be bought back. Second, the physical shortage I described isn't resolving itself. Industrial demand for silver is actually accelerating, not declining. Solar panel manufacturing, which accounts for approximately 20% of silver demand, is expanding globally. Electric vehicle production requires substantially more silver per vehicle than internal combustion engines. 5G infrastructure deployment is silver intensive. All of these demand sources are structural and growing. Meanwhile, mine supply is essentially flat. The largest silver-producing nations aren't seeing major new mine developments. The ore grades at existing mines are declining, meaning it takes more effort to extract the same amount of metal. When you have growing demand and flat supply, with inventories already drawing down, the math doesn't work unless prices go higher, much higher. Third, and this is critical, the Ghost Week operation created a situation where physical buyers got an incredible entry point. The Chinese buyers paying $32 to $37 during the crash aren't sellers at current prices. They're holders. They acquired metal for industrial use or strategic reserves. That metal isn't coming back to market at these levels. This creates a situation where available inventory is even tighter than before the crash. Fourth, the setup for short covering is textbook. You have elevated short interest, declining inventories, growing physical premiums, and we are about to enter a period of much higher liquidity as normal trading conditions return after New Year's. When the big institutions come back to their desks, when trading volume normalizes, when the market can't be pushed around by a few million ounces of selling, the dynamics reverse. The shorts who benefited from the low liquidity massacre are going to find themselves in a market where covering their positions moves the price against them dramatically. Here's the specific catalyst timeline I'm watching. January 15th, we get US inflation data. If it comes in hot, which recent trends suggest it will, that puts immediate pressure on precious metals shorts. January 28th to 29th, the FOMC meeting. Even if the Fed stays on hold with rates, any dovish language about future cuts lights a fire under metals. Mid-February, Chinese markets return from Lunar New Year celebrations, and Chinese buyers have historically used that period to accumulate physical metals. But the biggest catalyst isn't a specific date. It's the unwinding of the structural short position that was built during this operation. When that happens, and I believe it's a question of when, not if, you're going to see the kind of short squeeze move that makes the December 26th crash look tame by comparison. The price could easily spike through $50 once momentum kicks in and stops start getting hit on the upside. The physical versus paper disconnect we witnessed during the ghost week isn't going away. If anything, it's going to get worse. We're watching the early stages of what happens when paper markets lose credibility, when the people who actually need the physical commodity stop trusting that exchange prices reflect reality. This has happened before in other markets. When it does, the paper price becomes increasingly irrelevant and physical premiums explode. We saw this with palladium in 2019 when Russian export concerns created a genuine shortage. Paper prices and physical prices diverged by 30% at the peak. We saw it with nickel in 2022 when the London Metal Exchange had to cancel trades because physical delivery could not occur at exchange prices. Silver is heading down this same path because the fundamental supply-demand situation doesn't support current prices, and sophisticated buyers know it. Every ounce that leaves COMEX vaults, every ounce that gets shipped to Shanghai or Mumbai, every ounce that moves from registered to allocated storage is an ounce that is less likely to ever come back to the paper market. The float of available metal shrinks. The paper markets become increasingly synthetic, disconnected from physical reality. And eventually, that synthetic pricing breaks down completely. We're not there yet, but December 26th showed us exactly how fragile the paper pricing mechanism is. It showed us that prices can be temporarily hijacked, but only temporarily, and only at the cost of tightening physical markets even further. The institutions that executed this ghost week heist may have profited in the short term, but they've accelerated the very dynamic that will eventually destroy the paper market's ability to set prices. They've shown physical buyers that paper prices are unreliable, which encourages even more movement away from paper and into physical. They've created a doom loop of their own, except this one runs in the opposite direction. As more buyers demand physical, as premiums grow, as inventories drain, the paper market's influence diminishes until it finally breaks. You need to understand that what happened on December 26th wasn't about silver fundamentals. It wasn't about economics or inflation or Fed policy. It was about market structure and the exploitation of temporary illiquidity to engineer a desired outcome. It was about using leverage, automation, and timing to create panic and profit from that panic. But here's what they can't control: physical reality. They can't print silver bars. They can't create metal out of thin air. They can manipulate paper prices in the short term, especially during ghost week trading conditions, but they can't change the fact that industrial users need real metal, that mine supply is constrained, that inventories are declining. The gap between paper and physical during this event was the market screaming that something is broken. Shanghai buyers paying $89 when New York showed $75 wasn't noise or temporary dislocation. It was the physical market telling you what silver is actually worth when you need the real thing. It was arbitrage, failing to function because the paper price was fake, a mirage that existed only on computer screens, but not in the real world of bars and coins and physical delivery. And that gap, that fundamental disconnect between what silver trades for on paper and what physical buyers have to pay, that's your signal. That's the market telling you where price is headed once the paper manipulation loses its grip. I've been analyzing commodity markets for years, and I've seen manipulation attempts succeed temporarily and fail spectacularly over time. Gold in 2011, oil in 2014, palladium in 2019. Every single time, the pattern is the same. Paper prices get pushed to levels that don't reflect physical fundamentals. Sophisticated buyers recognize the disconnect and accumulate physical. Inventories drain, premiums grow, and eventually, violently, prices adjust to reality. Silver is in the middle of that cycle right now, accelerated by the Ghost Week massacre that created an even more unstable situation than existed before. When you look back at December 26th, from 6 months or a year in the future, I believe you're going to see it as the moment when the paper silver market's credibility died. The institutions that orchestrated this event may have made money in the immediate term, but they've lost something much more valuable: the trust of physical market participants. When Chinese industrial users have to pay premiums of 15 to 20% over COMEX prices to get metal, they stop looking at COMEX prices as meaningful. When Indian importers see paper crashes that don't result in cheaper physical metal actually arriving at their doorstep, they stop treating paper prices as relevant to their decisions. When COMEX vault inventories drain during paper price crashes, instead of building like they should in a properly functioning market, everyone watching understands that price discovery has broken down. This is how paper markets die. Not with a bang, not with an official announcement, but with a slow erosion of relevance as the people who need the actual commodity stop paying attention to the paper price. We're watching that happen in real time. The Ghost Week heist was spectacular in its execution, precise in its timing, and effective in its immediate goal of liquidating leveraged longs. But it was also catastrophically stupid from a strategic perspective, because it revealed the manipulation so clearly that even casual observers could see it. A 21% crash at 3 a.m. on the day after Christmas, when volume is at yearly lows, followed immediately by massive physical premiums and vault withdrawals, isn't subtle. It's not clever, it's obvious. And once something becomes obvious, once enough people see it clearly, the game changes. The next time they try this, and they will try it again because it worked this time, there will be more buyers waiting. More physical demand ready to absorb the paper selling. More entities ready to stand for delivery and drain the vaults further. Each successful manipulation in the short term makes the eventual reckoning more severe because it transfers metal from weak hands to strong hands, from paper players to physical holders. The investment implications here are straightforward. If you believe that physical reality eventually matters more than paper manipulation, if you believe that supply and demand fundamentals eventually assert themselves despite short-term price distortions, then you should be accumulating physical silver at current prices, not paper silver through ETFs or futures contracts, though those have their place for trading. I'm talking about actual metal that you can hold, that can't be liquidated by a margin call, that can't vanish in a broker bankruptcy. The Ghost Week massacre created an opportunity that won't last once normal market conditions return and the inevitable short squeeze begins. Every ounce you acquire at these levels is an ounce that someone else desperately wanted to buy at the bottom, but couldn't because the paper price didn't reflect physical availability. You're front-running the physical shortage that's becoming undeniable. You're positioning ahead of the repricing that has to occur when paper and physical markets either converge or fully decouple. Either outcome is bullish for physical holders. If they converge, paper prices have to rise dramatically to match physical. If they decouple, physical becomes even more valuable while paper becomes irrelevant. I'm not telling you to bet the farm on silver. I'm not telling you to use leverage or buy futures contracts. I'm telling you that we just witnessed one of the most blatant examples of market manipulation in recent memory, that this manipulation is unsustainable, and that the smart money is doing the opposite of what happened on December 26th. They're accumulating while others panic. They're moving from paper to physical while others trade synthetic products. They're positioning for what comes next while others are still trying to figure out what just happened. The data is clear. The inventories don't lie. The premiums tell the story. Physical silver is underpriced relative to physical demand, regardless of what paper markets say at 3 a.m. on Ghost Week. And when this resolves, when prices finally adjust to reflect the physical market reality that Shanghai buyers already understand, the move is going to be spectacular. The only question is whether you positioned yourself ahead of it or got left behind explaining why you didn't act when the opportunity was obvious.